Hello, everybody. Thanks for joining us for today's talk on asset allocation for multi-asset portfolios with Dr. Arthur Sepp. Dr. Sepp will present his risk-based asset allocation framework in great detail. So you want to stay sharp for today's talk, have your pen, your pencil, your note-taking supplies, all that. As always, great to see so many people here from around the world. We all have one thing in common. You've all joined the CQF Institute, whether as a current CQF delegate or an alumnus or just someone who joined the Institute to get access to the free resources it affords, such as talks as today's. I want to give a special congratulations to those of you who are our newest CQF delegates who joined us for the June 2020-25 cohort. Welcome. If you wish, for those of you who aren't CQF delegates, either current delegates or alumni, urge you to learn more about the CQF at cqf.com. We actually happen to have an information session tomorrow, hosted by our program director, Dr. Randeep Gug. He'll take your questions afterwards. So I urge you to join that if you haven't already been to an info session. Also, I'm happy to speak with you myself. You can email me directly, reach me on LinkedIn. I am Christian Figueredo, by the way, Senior Director for the CQF, Senior Director on the CQF program. Sorry I did not introduce myself at the start, but onto the business at hand. Today's talk will last about an hour. In that hour, we'll have about 10, maybe 15 minutes for Q&A. If you have any questions, look at that little button at the bottom, the Q&A button, enter your question there, enter your questions as we're going along, and we'll get to as many of them at the conclusion of today's, after Dr. Sepp has done the main part of his presentation, we'll get to as many of those questions as possible. So now to introduce today's speaker, Dr. Arthur Sepp. He is the global head of he is global head of investment services group at LGT Bank, that's based in Zurich. Arthur has almost 20 years of experience in financial markets in a variety of positions. Arthur also holds a PhD in mathematical stats from the University of Tartu and an MSc in industrial engineering and management sciences from Northwestern University. Arthur is a noted author on the topic of quant finance, and he actually, most impressively, won Quant of the Year award from Risk Magazine in 2024. It's now my pleasure to introduce Dr. Arthur Sepp. Dr. Sepp, thank you so much for joining. Over to you.
Good evening, or good morning, or good night, depending on where you are. Today, you will learn about strategic asset allocation, tactical asset allocation, and how to optimize it in a robust way. I will share my experience and you will learn something new today. So first, I will present a new method, risk-based method for strategic asset allocation with illiquid private assets. And also we then consider tactical asset allocation as maximization of portfolio alpha relative to tracking error. For those who are not aware of this concept, what is strategic, what is tactical asset allocation, I will do, I will present some introduction that will help you to understand these concepts. This approach, like what is important, this is approach that I will be presenting. It's especially the first part is a very typical approach of how institutional and private investors and family offices approach to their to make their allocation and investment decisions. And on the technical side, I will present a new approach for estimation of covariance matrix of assets when returns are observed at different frequencies, right? For example, for private equity, returns are observed on quarterly schedules. For most of hedge funds, on monthly, and for public funds, it's a daily. And it's really I don't think it's there is a robust solution to this problem, and I will present you one. This presentation is based on our joint paper with my colleagues from LGT, Ivan Ossa and Mika Kastenholz, and it's accepted to Journal of Portfolio Management. And actually, I will present you another better opportunity. It's still available on SSRN, but after we will sign, soon we will sign agreement, publish an agreement, and we have to remove it from SSRN. So you have limited period of time to get a free copy of our paper. So I will start with a traditional approach for strategic and tactical asset allocation. What is known, the process that is typically called capital market assumption is designed to provide estimates of expected returns for core asset classes. It's the first step. Second step is we need obviously to evaluate covariance matrix that typically some in-sample estimator using in-sample returns. And it's well known that the solution, this is Markowitz problem, that the solution is proportional or optimal SSA ways are proportional to the inverse of covariance matrix, where all the problems begin. And then SAE, as I said, is a core asset classes, and then it goes down to implementation process, which is called tactical asset allocation. So at SSA level, you select like equities, bonds, alternative, very high-level asset allocations, and then tactically you choose different funds and implement strategic view. Empirically, it's SAE explains between 80 to 90% of realized risk and performance. So SAE is quite important. It's very important in establishing the goals, risk profile, and so on. And therefore, also this process of, and obviously, as you see, like it depends on expected returns, and therefore, it's all major houses, investment houses, asset managers, that they provide their expected returns, right? To help, typically, is like say BlackRock would advise their clients how to implement SAEs for different client profiles, and in this process they need capital market assumptions. Capital market assumptions we can present as a typical to the one of you who studied finance in the school. You know this typically called frontier, where you put as X, you put asset realized or expected volatility, and on Y axis you put expected returns. And then you see profile. Usually what you learn in finance is that the higher is the risk by volatility, the higher must be expected return. It's in general true. We observe this pattern. And what is important? So here is important. CMAs are estimates of expected returns, but they actually don't do predict accurately realized returns. There have been a lot of studies. And also important that usually the one who already has some optimizers, you know that this Markowitz type of problem, allocate to assets with relatively higher expected returns, right? So therefore, I'm pretty sure if we run any optimizer, it will get allocated to this orange like alternatives lines, like direct lending, which is acronym for private debt, infrastructure, hedge funds. And obviously here you also can see that it's a little bit overstated. Like for hedge funds, this is BlackRock, so it's not mine. So it's a so they expect at 8% or like say 8% volatility or less. They expect the hedge funds to return more than 8%, right? So Sharpe ratio, implying Sharpe ratio over 1. And well, I don't think there is a hedge fund who is open for investment with a Sharpe ratio 1. Right? If there's a BlackRock people and you have something to offer, pin me up. So anyway, and also is important why. So this is CMAs is purely a marketing machine. It has nothing to do with actually trying to devise robust portfolios, right? Portfolios that could say work in different cycles, right? Adapt to different market regimes. And obviously, one also to notice in this, like in this business, right? These optimizers did not bring money to the house, right? Real action starts when any investment house will advise this kind of high margin. All these orange dots are high margin products, right? You don't do much with US small equities. These are low margin products. So, and once money is channeled, so once you allocate SAA, and you sure will allocate, right? Because these are the principle of typical optimizer is to allocate into assets with higher expected returns with relatively low volatility, right? And once the money comes through here, this is how investment house makes money, right? Selling you or allocators to end investors these products. And by the way, I have nothing against BlackRock. This is a typical practice, right? So it's if there's someone from BlackRock, that don't take me wrong. So well, let's do now. Let's talk about serious business. How we design robust portfolios that can thrive throughout different market cycles. Here, I very much like idea of through law, this adaptive market hypothesis. And the key proposition is that markets are non-stationary, right? And current prices, like there is no equilibrium as assumed by static CMAs. Instead, there's always some group of market players or conditions. It's all dictated by the way they see the current state of, say, evolution of economies, of markets, and so on. And this is like almost like a kind of a little bit of it's a competitive. It's a high. I mean, markets are highly competitive environment, and this is prices are changed. There's not a single state that will say preserve for like long periods of time. And also it opens up for all these interesting anomalies like momentum, low beta that exist that are difficult to arbitrage because they are not like say it's very like they are not short-term arbitrage. They're more like a longer, medium term, but these effects exist. one interesting paper is actually by Bernstein in 2003. He argued, he was one of the first probably to argue that long-term assumptions of future are doubtful, future of the markets. Let's put wait up. And policy portfolio must be responsive to shorter-term outlook. So what does it mean? Policy portfolio is like actually SAA. And I can tell you also, static SAAs are also dangerous because of survivorship bias. In 2008 or 2007, I worked in credit derivatives at that time, and I know that a lot of pension funds allocated to things called structured credit. The thing that promised 2% over LIBOR, right? And I'm sure that they had this structured credit in their CMAs and SAAs. And this since 1 year, and this thing is gone, and people realized sharp losses. Nowadays, and obviously nowadays no one, people forget structured credit. There's a sister product which is called private debt, and it still didn't survive as it didn't go through a cycle. So I'm pretty sure after, like say, next cycle in maybe less than 5 years, it will change, it will drop out. So even the static SAAs, say it needs always revised and say adopt to what exists in the market. Therefore, this is introduction to the work. So next I will present the highly mathematical concepts, but this is the idea that what we want is to have something that adapts, and also here, like responsive for short-term outlook, what we can say that returns are highly unstable, right? Hard. It's not, and I can tell you, in, say, hedge fund industry I work in, no one tries to predict returns. We try to predict characteristics that are associated with higher returns. But nevertheless, something easier to predict is risk. And therefore, if we want to, say, follow some short-term strategies to adjust our portfolios, risk is something that we can utilize the process. But again, so I start with a very, again, for you to understand all the process, I will present you. So this is an illustration from our paper, and this example of a typical SAA. So first it starts with level 1 asset classes, which is fixed income, equity, and alternatives. Alternatives including everything from private equity to hedge funds and to commodities and so on. And this is we choose like a balanced mandate, which is 25 fixed income, 35 equities, and 40 alternatives. And usually it's further is subdivided, strategic asset allocation subdivided into asset classes. In fixed income, so you have rates, credit, high yield, emerging market bonds. Equity is just global equity, and alternatives, as I mentioned, it's from hedge funds to insurance-linked bonds. And usually we provide, or investment committee provides, usually provides on asset bands, like how much you should be invested in equities, what would be your minimum and maximum weight for each asset class, and also sometimes on specific asset class level, how much you would allocate. And then you can run optimizer, right? You can say, okay, use BlackRock or someone else, take their CMAs, run optimizer, and get your SAA, right? Job done. And or our model, actually, that's better. What is also here, because we are entering the world of illiquid stuff, since unnecessary rebalancing, like from monthly to quarterly. And this is especially on tactical asset allocation, because private equity, you cannot. The reality, actually, if you do it, say, so here, what I understand here by private equity, actually, here my next slide. Usually, so there are proxies, right? So private equity, and we use proxies. Sometimes I understand as direct investment into the tranches or directly into companies, maybe some big endowments or institutionals or private investors, they may have direct investments. Typically, on our, say, allocation level is more fund of funds and secondaries. That is so for us, private equity would be, like, say, fund, say, usually they have limited liquidity, also quarterly or sometimes annual. And therefore, it puts a constraint on how frequently we can now rebalance the portfolio. And later I present, here is very important. It's a very well-known problem that there is a returns, the thing called return smoothing in private equity. The reason is simple, because they need to mark once a quarter, right? Or maybe once a year. And therefore you have, it's a human bias, right? To overstate their performance. And they well known. And usually what we do, we run some like EWMA type of like rolling, how much we should say increase the volatility, not returns, but the volatility and the betas of these funds, right? And so on average for private equity, we need to increase it 1.4. So here I wanted also to show this historical frontier, right? On the left, you see this is assets in our SAA universe. So obviously, historically, and we also adjust. So here we adjust volatilities of private equity, private debt, hedge funds, ILS, by these corresponding estimated factors. So we also see that it's true in some sense that like say higher volatility is associated with higher returns. And also on the right side you see beta. So relative to beta of just equal within asset class portfolio, right? So betas actually only for rates is a negative, but it still is because of early periods. For if we measure for past, so this is sample of last 20 years. If we measure last 5 years, rates are actually positively correlated to overall market. The same with insurance-linked securities, and therefore it's challenging to have a good, say, way to find a robust portfolio, even in a static way. And obviously we need to do something dynamic. We follow risk-based approach for strategic asset allocation. We don't need expected returns, actually, right? So we don't, as I mentioned, in my opinion, those are marketing quantities. And therefore, we just don't want to use noise. We want to use only something we can measure, and covariances we can measure. I explain you why. It's not also easy, right? We have assets with different liquidity profile. So something private equity we can observe only quarterly, right? We want to measure the relation of this with other asset classes. It's not an easy problem. But let's start that we can measure the covariance. With trust, we can do it. And therefore, we try to, we look at risk contribution, actually, right? Instead of thinking of weights, we think, okay, for each asset class, we design a risk budget. And then correspondingly, risk contribution is risk budget times portfolio risk. Right? And here in this table, so for each asset class, we assign budget, right? Obviously, equities, it has take the most of budget, 75%, even though the average weight is 35%. This is just a nature of high volatility and high correlation to other asset classes. The way how we calibrate budgets, right? We usually run a little bit of inverse optimization. In some sense, we know say average weights, what we would expect over this, say, past 20 years, right? We kind of, okay, we would like equities to be 35%. We would like to be maybe private equity to be 15% and so on. And then we kind of, okay, now we just need to find risk budgets so that more or less we generate weights over the cycles. Of course, this is important that this average realized weights over the last 20 years. But the important thing is that here we want to keep the idea of risk budgets or equal. So its sister is called equal risk. I think, yeah, it's a term designed by Bridgewater's. Idea is, say, if you have 4 risk types and we don't know, say we have n assets and we don't know, we know that they are attractive over the cycles, right? But we don't know like how, say, we cannot make any estimates of what would be, say, expected returns of each of them like in 5 years, right? So what we do, we just, okay, we take equal risk exposure, not equal weights, equal risk exposure. And this is what we do. We just a little bit, we have different risk budgets just to indicate different exposure profile to this investment opportunity set. And on a figure, I want to show the exposed risk contribution. So we see actually these contributions are more or less stable, right? It's particular for equities, right? So of course the weights of equities will change, right? Like say on average it was 35%. Actually, most recently it's increased to 45%. And actually, reason why, because rates they actually one of the, say, diversifiers that actually risk contribution can be negative if the asset provides diversification benefits. It was the case with rates up until mid of 2022, when rates suddenly became very correlated with equities, and therefore, from a risk point of view, you would hold equities, right? Like say, if an asset provided you diversification and suddenly it's not, you just you cut its weight. And what had happened, and actually it's also coincided with negative performance in rates. But here we are not making any assumption on expected return. We are just talking of risk. We are just looking at the risk profiles. And next is a risk. So and next is a TAA portfolio. And TAA portfolio, as I said, SAA is like a policy. It's probably revised yearly or more frequently. But now comes implementation portfolio, where we need actually allocate to managers or to specific funds. And here again, we use, it's just for purposes of papers, we use indices. In practice, I think most of these indices have ETFs. So you could also say replicate and implement it through ETFs. Of course, in practice, we use actual managers. But here, our purpose is to provide you some guidance, and you can re-implement it or play around with our methodology. And now we consider how to solve TAA portfolio. For TAA, it's usually the same. You have asset classes, a sub-asset class, which is SAA, which is also part of SA allocation, and minimum maximum. And here I will discuss it later. Here we introducing these alphas. As I mentioned, we will introduce some tactical alphas. Turnover group also is important because here we will be doing TA. In our case, is monthly, and usually TA is done more frequently. But it's important to keep track of turnover, in particular for low, say, less liquid stuff like private equity. And here is again rebalancing. And actually, if you also go to actual managers, most managers, especially in private space, you can only rebalance quarterly at most, at least. In hedge funds, monthly. So this is also is a part of, say, inputs for the optimizer. And now, but before that, now let's consider the covariance matrix. How we should estimate it. So of course, there's a lot of, say, traditional methods that are based around idea of shrinkage, say, towards a target, say, target covariance matrix. Typically, they work well for one asset class. For if you work with equities, it's fine, but they are not suited for multi-assets because, again, different liquidity profile. How do you choose, like, between, say, daily, monthly, and quarterly? And also covariance, like for equities, is clear it's one, right? In limit, all stocks are more or less correlated, one. For multi-asset classes, especially equity, bond, right, there's not a fixed target. Risk also, there's a lot of, say, risk models, but their purpose, I think, for just slice and dice of, say, your portfolio, like your ex ante portfolio risk. They have relatively poor job predicting exposed risk. And again, how we need to use risk models, we need to extrapolate quarterly returns to do something about it. And factor loadings, right? If you have many assets, many factors, you need to solve this problem. And we show how to solve it. So in the end, we choose to work with a factor model. Reason is simple, it's just enormous dimensionality reduction. It's enormous. You especially when it's asset, like with multi-asset classes. And your investment universe is a few hundred different funds, right? And you need to properly estimate covariance between them. So the only answer is a factor model. And this is classic stuff. So we have M factors, n-dimensional factors, and n-dimensional Y vector of returns. And what we do, we don't do interpolation of returns, just for each liquidity. So for each return profile, daily, monthly, or quarterly, we have separate factor model. Right. So instead, so as I show later, we use interpolation of risk of betas and residual walls. This is, in my opinion, is much more robust to do, much less noise, because you don't need to extrapolate. You just use the last available betas and idiosyncratic walls. And estimation, right? This is a part that I like in this. This is my favorite slide. Ones with a very serious equation. I see that we have already around 20 minutes left, but I would like to spend some time here. Right? Obviously, you all know, right, that simple, say, multivariate regression are very badly suited for, say, high-dimensional problems, right? And obviously, we need to do statistical clustering even for factor estimates, right? The traditional way is use lasso, right? Problem with lasso is that it doesn't have a structure. So imagine you have maybe 50 funds or 50 investment opportunities in fixed income space. And when you run lasso, they all end up, all these funds end up different, especially when factor basis is correlated. You also, and then you end up like a risk profile is very different. Some funds, like even within the same like say same duration, same geography, you may have different models for essentially the same investments, right? So here is what is called group lasso. Group lasso identifies a group of stocks, of assets, and it says that if a factor is significant, it should be significant for all of them, or zero to all of them. So this is what is called group lasso. How we set groups? We don't use, definitely we don't use, say, prescribe. You know, for all reports, risk reports, you always have someone assign which stock or fund, what is his category. Don't do that. It should be statistical, right? So I show you later how we use a statistical method to cluster this stuff into groups. Then we run this group lasso. So this is a typical say L2 is a square root of 2 norm. So obviously, when group generated to particular instrument, this become L1 norm. So your classic lasso. But if it also important is this. Usually, I am in the I'm in the camp who likes exponentially weighted stuff, because I believe like you should never discard any data, no matter how old it is. But I want to assign more weight to most recent data, and why I use this weight. And so we need to solve this lasso problem to get betas. And obviously, we need to choose factors. And I just, again, I have, it's a topic of another talk, how to choose risk factors and whether we can use industry factors. Here, I just keep it, maybe it's another talk if organizers like and audience like this talk, we can continue sometime with another one. But here, we just take investable factors from our universe. Of course, we need to define covariance between them, right? That will be the basis to compute asset covariances. And here, again, EWMA, exponentially weighted average with a span of 3 years. And here also we can see how things behave, right? Why I like it's like some sort of non-parametric assumption, right? So obviously rates at certain times they were negatively correlated to the rest of asset classes, but more recently over say past years they become very correlated. And this is our like a time homogeneous estimate of what is the current structure of correlation between core asset classes. And now how we select clusters. So here I have, we do like for both TAA universe and SAA universe. And so we use correlation matrix between, in this set, obviously we can compute correlation matrix. So once we isolated that this is quarterly returns, we compute correlation matrix. We use word clustering. And word clustering, if you remember, these sleeves that fall behind the black line is a clustering distance. Typically, it's half of the largest difference, right? So here is how we obtain these clusters. So for quarterly instruments, we have 4 clusters, like hedge funds, like CTA hedge funds, insurance-linked bonds, and actually very close private equity. Right, it fell a little bit below the cutoff. So it's a distinct asset class, but obviously it's very correlated to, say, statistically, it's not correlated, it's similar. So with word distance, we measure the statistical similarity, right? And also for monthly instruments, we also have 4 clusters, right? And now here, how we use these clusters. So as I mentioned, let's look at possibilities, how we can estimate our factor regression model, right? So on the left side, you have, when we just run multivariate regression, so with lambda set to 0, we get like no penalty, right? And therefore, obviously, say for CTAs, for example, right? It's a very typical that it's alternating. These betas become alternating. This is typical of this, because factors are very correlated, and it tries to find an optimal subset, the optimal projection, and it becomes very noisy, right? Now with independent lasso, and these lines are the clusters that we estimated. Of course, clusters only play a role for C, for hierarchical group lasso, but I just use it through. Here, for example, with independent lasso, we reduce dimensionality. You already see that a number of elements fail, but what typically I find non-intuitive, for example, for bonds, right? We have a lot of different exposures, and effectively, for me, like I would prefer, say, especially for credit, emerging market bonds, other fixed income, that is more or less aligned. If one of instruments have exposure to one factor, all the rest in this group must have. And this is only possible with hierarchical group lasso. So, for example, you see that for private equity, and so, for example, for fixed income, right? So this is a fixed income cluster, and all of them have non-zero exposures to rates and to credit. So that's the idea. So with both this hierarchical group lasso, there are a few advantages. First, do dimensionality reduction using the factor basis. Second, we introduce clustering, like for lasso, but we also introduce structure. And it's important that maybe we have a slightly more number of parameters, but here, effectively, the lasso case, we have universe of, say, 40 assets, we have 40 models. Here, for each cluster, we have a model. So we have 8 models. So therefore, these things are important for out of sample performance. Now I have 15 minutes left. I quickly go through the rest of my presentation. So now once we know the factors, we just, this is implication of how factor covariances work. Right? And as I mentioned, betas we can forward field, right? So now we want to compute on frequency of risk factors, and choose week monthly, but you can choose any frequency. The only thing, like, okay, betas are non-dimensional, they do not depend on the frequency of estimation, right? Individual residual variance is dependent. You just need to extrapolate the last one and to apply proper adjustment factor. So I leave it for you to go through. This is what I call, it also seems to be new, like this. Again, for me, everything must evolve continuously through time, right? So I'm say, not big fan. I'm always using some sort of weighted stuff, so that we can also, for illiquid, so the ones that have quarterly liquidity, we use this adjustment. We compute as so adjustment. It means Newey-West adjustment. We account for autocorrelation, right? So the variance of this instrument will also depend on autocorrelation, and it is positive, so variance will be increasing, right? So I showed you the once we compute this say diagonal adjustment for variance, it will be above 1. And then we adjust our estimated covariance matrix. So now, yeah, I just wanted to show you example of what comes out of this process, right? So this covariance matrix you can already use, we can use for in our optimizer. As I mentioned, so here different assets with different liquidity, right? For example, private equity, right? We see that it's say correlated, strongly correlated to equities. And bear in mind that correlation again is non-dimensional. Right? In variances, you will see impact of our adjustment in betas, right? Yes. So let me go. So now we go interesting part. So now we're done with risk. Now we go into alphas, alpha characteristics. And again, as I mentioned in your in introduction, talking about adaptive market hypothesis, like I personally I don't believe in CMAs, but I believe in a factor like these characteristics like momentum, low beta. These factors are shown in many studies, right? And these are basic stuff. This is not some idiosyncratic, like say, fancy style factors. This is stuff that is shown to work across all asset classes, and therefore we can also use it for fund selections, right? Or say here we are talking more about like say ETFs, funds. We are not talking single stocks, right, or single bonds. But this stuff also works, right? And we use momentum, beta. We agree. Of course, it's important to use proper within the class normalization. Reason is simple. We don't want to say overweight equities in expense of bonds, right? Everything here is risk adjusted. So on the scale of per 1 unit of risk, but still we don't want to say TAA process to do some sort of a macro decisions of what asset class should be overweight. And therefore, these really group adjustments, they help a lot. And for alpha type of investment, so typically beta is either most of the, say nowadays, like 50% are some sort of investments represented by some index or some ETF or some passive strategy. These are beta type of investments. For alpha type of investments where active management is involved, so hedge funds, private equity funds, and here we just use beta adjusted excess returns. And everything is normalized. So both are like say both private and beta and alpha scores are normalized, and that they like it's a say distribution with unit variance. And you see through time it evolves, right? You have say different asset classes, like say leverage loans at certain points is positive, negative, positive, and this coincides well with this adaptive market. That things change, right? And throughout this 5-year periods, no CMA can survive this. You cannot, let's say, um, okay, it's a topic of another representation. So now, well, so we have now covariance risk, we have alpha, and finally we come to say TAA, the tactical asset allocation, right? So actually, I started you show to how to get inputs, and now we kind of run the problem, right? So we just want to optimize alphas, and we can. And important here, we use SAA portfolio to define our tracking error, and this is very important. We don't want to overbet, right? No matter how big alphas, still want to have consistency with SAA. SAA is only risk-based, right? And we somehow we don't want. It's almost imagine this like pickers, right? These alphas are like algorithm, but it could be also like say human that you pick. You won't always constrain them, right? You don't want to say tactical decisions ruin strategic allocation, right? So we do this group asset class groups. And also, as I mentioned, turnover constraints are important, and we have different groups. Obviously, public funds we can rebalance as much as we want, right? Private funds, very tight constraints. And again, sub-asset class constraints. So I have 5 minutes to show you examples. And obviously, so for our universe, right, what I wanted to show, static benchmark is equally weighted within asset class. And we can show that both our SAA beats static benchmark and also TAA process. And again, this is on index instruments. Of course, we observe if we do say actual portfolios with actual managers, we also see similar picture. And I think so SAA, and again, SAA, it only uses a risk profile. It doesn't do any prediction, but it efficiently utilizes the risk budget. And the next one that is my favorite one in this analysis, so it's a Brinson style attribution. So again, SAA we use for TAA process, SAA is a benchmark, not a static weight. Static weight is for SAA is a benchmark, but for TAA we use SAA as a benchmark. And what we see that all our performance relative to SAA comes from instrument selection. And this is exactly what we want. We don't want to say TAA process to do some macro bets. We just want proper instrument selection. And we also active performance is attributed equally to fixed income, equity, and alternatives. And this is, for me, it means that there's a substance to this analysis. Last one, tracking errors, also very important. We don't want to overbid. And tracking error, when you do on a total tracking error, you have some better correction. Sometimes it works that say equities, like say in 208, tracking error was dominated by equities tracking error. But it's not always the case. You should not rely too much on a correlation, this say, overall. And liquidity. Of course, here it's important that we treat liquidity in different buckets. And for low liquid private equity, do per year 25%. This is normal, even though our say long-term allocation is around 50%. So this is quite decent. I put up some code for you to experiment and to play around. Not for all the analysis, but for to compute covariance matrix. I actually found that Group Lasso, obviously there's a scikit-learn, but they don't have this specific problem for Group Lasso. They have something called multitask class. It's a different problem, and also they don't do exponential weighting. Like for some reason, I don't know. In the classical machine learning, they always assume that your data is like it has equal weight of all points, right? Obviously, as I said, I like to define the spans, right? And here I put your example how you can get into this whole machinery. Usually, so my package optimal portfolios, I designed out just for fun. For me, I know there are also several packages that exist, but none of them does a rolling portfolio analysis, right? What you want effectively, I throw a bunch of prices, and I want that optimizer is able to detect itself when it can use asset to compute covariance matrix, right, and when it can include to asset allocation. Right? So this stuff that I implemented, it's effectively gives you rolling stuff. And I also try to follow, at least for statistical stuff, to follow the convention of scikit-learn, right? You define your Lasso model. Covariance estimator can be general than Lasso model, right? There are more covariance estimators, so it's a argument, right? And you define the period, and then you can fit rolling covariances. It will just produce you effectively dictionary of by date, and you have a covariance matrix. Then you can now use in your rolling back test, right? And this is I implemented the risk budgeting, right? And you can compute weights. And of course, once weights, I have example in QIS, it's another my package, but you can use in your own stuff. Once you have weights, you can kind of run a proper backtest. So that's it. I actually took 1 hour, so I suggest, because it's evening, at least in Europe. So the one who wants to ask questions, please go ahead. Otherwise, for the one who must go, I will say thank you for attention.
Well, and Dr. Sepp, thank you so much on behalf of everyone who attended today. We had a lot of attendees today. And so thank you for taking the time, even to go over and to cover everything. Much appreciated. But without further ado, let's go to the questions. We have a number here from Nadetto. Nadetto, I'm just going to pick your most recent one. I hope that's okay. And if you have any other questions, now would really be the time. So Dr. Sepp, Nadetto asks, rebalancing with illiquid assets, the model accommodates different rebalancing schemes. How does it handle the lockup problem if a private asset's optional weight changes during a freeze period?
So yes. So obviously, if I understand it correctly, so one thing is, of course, backtest, right? You can assume you can rebalance, but it's true that when you say you have actual portfolio and you optimize, so you have current weights, and then you have new estimates of covariance matrix, new alphas, you update a new weight. But obviously, some funds you cannot balance, so you keep current weight as fixed, right? So you for each, say, current operational, what I call operational rebalancing, you need to provide a current weights and minimum and maximum. For funds you cannot rebalance, you said that effectively minimum equals to current weight equals to maximum, so it will not be rebalanced. That's it. So if it answers your question.
All right, and Nadetto, if you have a follow-up question, feel free to put it in. So anonymous Dr. Sepp asks you, good evening. How did you arrive at the constraints? Did you assume the bands, i.e. provided by a hypothetical committee? Thanks in advance.
That's a good question. Yes, it would be a hypothetical committee.
Okay,
Usually these are defined by committee anyway.
Excellent. I guess the definitional question, Akeen asks, what is SAA and TAA? How do they differ?
So this is SAA. SAA, it's defined on, say, top asset classes. Like, say, you have here we have 10 or different. This strategic asset allocation, ideally, you are supposed to say you come up with weights and you keep them fixed for whatever foreseeable future, and it just answers the question, say how much equities you want to have. I'd say in this case 35% equities. So this is SAA. Now comes TAA. TAA answers questions, okay, how much, say, within equity bucket, how much you want to have US, Europe, Asia, emerging markets. So this is TAA. TAA, it decides, say, sub-asset allocation, right? And furthermore, say, within, you can ask also within US, do you want small caps, you want growth, and so on. So this is part of TAA.
Excellent. Dr. Sepp, just being mindful of the time, do you have a few more minutes for questions?
Yes, I do have that time.
Excellent. Good. So Michaelis asks, well, first, thank you very much. His question is, Group Lasso was used in non-parametric estimations and in fitting curves. How does this method behave against the classical constraint optimization? He says, I use BFGS methods to estimate risk budgeting methods.
I suggest the author will contact me directly because
Okay.
I don't understand. So,
And Michaelis, if you could provide maybe a little more
Yeah.
detail for that question or expand it a bit, that might be helpful.
Yeah, Lasso is parametric method. Like it's a data. In the end, we run. This is our parameter to estimate. So it is parametric method, and we solve it. Like of course, there are specific solvers for quadratic problems. A BFG, if it's the one that in SciPy is more like say non-linear solver, but obviously there are many ways you can also use the same problem with a non-linear solver.
We have a broader question for you from Anonymous. What is the benefit of this approach? What is the benefit of this approach over more traditional asset allocation optimization models?
That's a good one. That well, it's more like say conceptually, right? Conceptually, as I said here, conceptually, if you want a traditional method, right? I explain how it got implemented. You need CMAs, right? And so traditional method is this. It's effectively Markowitz. It tells you your SAA weights are proportional to inverse covariance times expected returns. So somehow you need to believe in this, that there's a group of analysts that can predict your expected returns, and that you can follow it, right? Obviously, bear in mind there's a lot of studies that we refer in our paper that this exercise is very noisy, right? In the end, there's a lot of noise, and why people, even if you use some optimizer, you're typically very much constrained. So it's really you can deterministically solve the same problem as your constraint optimizer. So therefore, there's no optimization at all. And in our approach, we work with risk. So it's a classic idea based on, say, Bridgewater's risk parity. Here is a slightly more applied for maybe the broader universe, right? And that is defines your, say, SAA, like your target. And plus, what also traditionally what people do, they revise, like say they have some revisions, maybe quarterly, monthly, based on market conditions. But it's hard to find a systematic way to do it. And what we did with these indicators, with classical like behavioral biases, right? This is, I think, a proper way to introduce some like concept of alpha characteristic to your optimization. But the process is two steps. So that's why I think so in the first step, we kind of control for overall asset allocation just based on risk. In the second, we introduce some alpha characteristic, but we then use tracking error constraint relative to benchmark. And this is, I think it's new.
We have a number of questions still. We'll go to Sarah. Yeah, I guess we'll go to Sarah for our last question here. Well, how can you best account for the coexistence of public and private assets when there is sometimes an overlapping in factors?
That's also a very good question. Okay, so this is right. If we look at, say, private equity, right, we have hedge funds, okay. Of course, they are very correlated, right? You have exposure to hedge funds. What so they have private equity has better exposures to public markets, but it has also some, like, say, for me it's illiquidity alpha that maybe on average maybe, or leverage. Actually, also some people say that it's just a leverage to public markets. And why it exists, I think it's a leverage constraint. All these anomalies, or most of anomalies, exist because if you want higher return, you say, and you have access to leverage, you probably just leverage Nasdaq or S&P 500. If you don't have, say, don't have access to leverage, you go to public private equity. That's my answer. That effectively is just, it's a leveraged risk premium. And if you want higher returns without taking leverage risk, you go to private equity.
I hope that answers that question. Today's lecture and the slides will be posted on the CQF Institute in about a week. We have a lot of questions about that as well, because Dr. Sepp, of course, some folks want to go back over a lot of your talk today. But thank you very much, Dr. Sepp, for today's talk, and thank you all so much for attending. We hope to see you at upcoming events. Again, if you have any questions about the CQF itself, happy to speak to you myself. Also go to cqf.com, register for tomorrow's info session, download a brochure. But it's a pleasure having everyone today. And Dr. Sepp, once again, thank you very much.
Thank you for having me here, and it was fun.
Good.
Yeah, as I said, looking forward to seeing you again.
I'm sure we'll have you back soon. Take care.
Thank you. Bye-bye.